I'm sure you've heard this saying many times of you got to trade in the right market context, so you got to be able to adapt to the market. And many people say exactly this, but they don't say exactly how to do it. Recently, we had a training inside of my program called Ultimate Trading Platform, where we teach people how to adapt to the market context. Very simple tips with some examples in the charts that you can use to adapt properly to the market context. How do you adapt to trends? How do you adapt to Saturday's market? How do you trade these markets? It's very crucial to understand. So I'm giving you that training here for free because I think it's really important to learn that stuff and that no one talks about this pretty much online. So you can become a master at market structure. We'll get to that training hosted by Michael Toma, a fund manager and full-time trader. And I'll catch you back here at the end.
Let's look at the left side. This is for identifying a changing market. Right? Can we do this? Well, let's think about the core basics of a trend market. All right, remember, the trend is your friend. The most overused and overabused. I cringe when I hear this trend is your friend stuff. I just not a big fan. So, but the trend is your friend, right? Trend market. The go-to choice. When people ask about strategies, they all want to play, or a majority want to play, this sort of trend game. Or, I entered here because it looked like the trend was up, that kind of thing. Right? Always talk to people about chop markets and taking advantage of the things doesn't really add for a good, good topic at happy hour. And how we define trend markets? Well, a lot of the times we use indicators, lagging indicators. Hence the reason why we're talking stochastics, the oscillators, stuff like that. All right. So can we do anything about that? Well, let's see what we can do. But those are sort of the components of sort of the desire to trend trade. Now, in choppy markets, there's at least a perception of less opportunities. I personally would disagree. But the perception is that if it's not trending, then I'm going to kind of hold back and wait for a trend to start, and then I'll get in. Okay. Again, I'm speaking generally, right? The P&L, again, allegedly, is exposed to higher risk. Well, why is that? Well, it's perception. I don't think so at all. But the perception is in the choppy markets, exposed to high risk because you can get chopped up, right? You try and get something, it stops you out. Then you try it the other way, it stops you out, right? So you have this death by 1,000 cuts, which is the reason why a lot of people don't trade choppy markets. It's also difficult to identify until it actually starts happening. So someone says, I'm not going to trade a choppy market. Well, how do they know? Because the past so many bars or so many days or whatever it is, it's just chopping around. Well, if I knew that when it started, I could probably have done pretty well. All right. So they are a little difficult to identify as opposed to sort of a trend market, which kind of visually has this, like, you don't even need to define it. It kind of just looks like a trend. Right. So how can we best identify this shift early, or can we do that in itself? Right. So that's the question we're going to talk about tonight. Obviously, we're presenting it, so there's probably a couple of hints that we can throw at you and see what you think. You can go to the next slide and see what we got. I put potential in brackets for a reason, right? The early identification of a trend market, right? And again, this is probably something that, you say, well, I'm looking for, a certain thing, a pattern to arise, and then it's breaking out, and then blah, blah, blah. We're in a trend market, at least the perception that that's what the definition is. But what are sort of the early identification hints that there may be the early stages of a new trend market? The most logical one that most people think of is the breakout of a range. That would make sense, because if it's the chop market and it's a trending market, if it breaks out of the chop, one can say at least it's trying to establish a trend. So a breakout of a range is sort of that initial hint. Okay. Next one, a successful retest of the chop area. So if you have a breakout, right, and it comes back and pulls back and retests that original chop area and obviously rejects it, probably not a bad idea to say, well, it's definitely maybe not a trend market yet, but it's definitely not chopping. Okay. So this is the early hints, again, early identification. Right? One that I use a lot, and this is sort of, I'm very rule-based. So the first two are sort of visual. This one is very rule-based. If you have two moving averages, all right, and the separation between those goes beyond the norm, okay, now we have something. Because in chop, you're going to have the moving averages, going back and forth, right? Even if they're not going back and forth, they still may be chopping because the moving averages are still tight, right? Think about like Secretariat, like a 9 and a 30 or something. But when those two moving averages start to separate, the gap in between them starts to separate, we have something here. And not only do we have something that's data driven. Okay. It may fall apart as soon as you identify it, but for that moment, clearly markets and chop don't have moving averages that separate. All right. So we can put now we're putting a little math behind it, which I love. Okay. Less decision making. Right. How about quiet oscillator changes? All right. I'm going to show you an example in a slide in a minute, but sometimes when you look at a trend and oscillators are generally sort of lagging, but when you have certain dynamics of an oscillator that changes, when price isn't, should be that hair on the back of your neck, or at least a coming out of you and saying, maybe something's about to happen here. I'll show you a visual in a second. And then one of my other favorites is an extended consecutive inside days. Now, I put inside days meaning it's a daily chart, but you could even have, intraday type things. And in the buzzword in the prop world and hedge fund world is we call them NR7s, which are basically referred to as narrow range 7. You may have heard that. You might even see that option on your platform, which will trigger an alert when an NR7 comes up. Basically, it's the current bar is the smallest of the past 7 days. Okay, so is that an early identification of a trend market? Very possible, right? It basically is screaming that it's a chop market, but it's getting to the point like a pressure cooker where it's the smallest in the last 7 days. Something has to give. Think of it like a pressure cooker moment where it's just been chopping all this time. And then the last one, this NR7, anticipate a breakout of some form. And then obviously if you have a breakout of range, successful retest, potential for a change in tone in the market. Okay. Some interesting one, a little day driven, a little hypothesis, but the NR7s, Hull, I'm going to show you in a second. And the two set Moss separations, very data driven, very visual, and can add some edge into defining what type of trading strategies you want to use. So let's go to the next slide. I'll show you an example of the Hull. So here's an example. Actually, I think it was taken yesterday. I freshened it up. So when you have an oscillator, and I'll use like a Hull moving average, but any type of sort of slow moving oscillator that has sort of a tone change, that at least highlights a tone change. It's not an indicator. It's not a buy and sell thing, but it indicates possibly a change in tone. So if you look at this example where price has come down, the red Fibonacci bars, right? And then you have some chop there. But really the past, right before that arrow, the last 8-10 bars are pretty much just chop. Safe to say? And then all of a sudden, the whole moving average starts to change. Is that a trend market? No. But it's amazing how many times is the first sort of hint that we're starting to go into a trending market, right? So those little hints, such as whole moving average, these are early identifiers of potential trend markets. So is it going to change my strategy? Is it going to change my rules? Yeah, it could act as a filter, right? Maybe I'm going to close my winning chop position. Maybe I'm going to sort of start focusing more now on my trend-based strategies, things like that, right? Whole moving average, I use it a lot, and I use the 50. Everybody always asks me when I mention an oscillator, what setting do you use? I tend to use a 50. It seems to be works out really well. Okay, so point here is notice price, how it's not trending, but we have some tools to give you a little hint that something may be changing. Pretty cool stuff. So let's look at now potential early identification opportunities of a chop market. So we're basically making the assumption here we're in a trending market, right? and like we are now these days. And it's very easy to identify what a trend market. So think of like, some of the ones that are just trending and they just don't seem to go down these days. All right. Easy to define. So what's going to be some of the hints, the early identification clues that may indicate price may be due for a pause, right? The first one, and the one my go-to all the time, is when Bollinger Bands start to tighten and you'll see them pointing inwards. All right, it's a great one. I'm going to show you an example of that in a second. It's my go-to. When those bands are expanding, that means markets are trending. Price is breaking the upper band or the lower band, and it's riding them. You've seen that a million times. And all of a sudden, that initial curl in, right, that squeeze of the Bollinger Bands, right? That's the first trigger to say, maybe this move is either over or due for a pause. So if I'm in a trend-based trade and I'm in a winning trade, what do you think I might do? Maybe take some off the top. Maybe move my stop. Anticipate maybe chop. Maybe I'm okay to absorb that. Okay. But I'm going to start thinking maybe due for a pause. Right. Volume spikes. Right. At the end of a move, sometimes there's a volume spike, not all the time, but particularly in short-term trading, we see these like last big thrusts, and those are basically the newbies getting in late. That big thrust of volume and possibly signal the end of a move. Does that mean a complete 100 reversal? No. A lot of times markets go up, they pause, and then they reverse. So the early identification of a chop market or the end of a trend market could be this volume spike. So you can put, and I do this, I have an alert on my volume bars that when it breaches a certain high, it'll trigger an alert, at least get me to look at it. Right? Average true range, average daily range, things like that, going below average. So they were above average, now going below average. Just something something I monitor. All right. But those are things say maybe things are start to slowing down now, even though the trend is still in place. All right. We haven't seen price sort of transition yet. This is one I like too. And for you pairs traders, who I know we have a lot of them, the FX pairs traders. Someone says, well, do you trade stocks? I said, well, they notice on my screen, I have a lot of equities on my screen. Says, do you trade them? I said, well, not really. I mean, I do, but what do you do? One of the great valuable things that your platform gives you is if you have some of the major equities, like some of the NASDAQ and some of the, the techs, things like that. When you have a kind of a bull rage and everything is green and price is rip roaring, and then all of a sudden you start to see some red come in, where you may have 50 stocks on your radar screen, and then all of a sudden some things are just not occurring, right? That are all of a sudden they're not all green. So you have this sort of Christmas tree effect. Alex, I think you went a little too far on those, but you can pull those back a couple. There you go. So when you have a green screen, when screens are green, everything is good. Markets going up or all red, markets going down. But when you see this transition, it starts to look like a Christmas tree, right? But price hasn't really, it keeps on trending. A little hint there, right? And some of the big ones, the Apples, the Nvidias, the Amazons, when those are all green and the whole screen, and you start to see red and you start to see the big boys start to turn red, could be the early hint of a chop market in the equities as well as possibly the pairs. Okay. So that's why I have a radar screen full with everything, commodities, equities, and the big boy pairs. Right. And again, the initial inside bar. So if we have trend markets where, things are going up, obviously a trend, and then you get that pause, that inside bar. Does that mean the trend's over? Maybe it's just a pause. But if you're having a real extended move and then you start to see these inside bars, doesn't mean it's going to reverse. But now maybe we identified there may be an opportunity on the chop side. Right. Again, early identification. Early is the key here. All right, let's go to the next slide, we're going to show you an example of that Bollinger Band squeeze, I call it. All right. So you see the Bollinger Bands here, just a basic, simple, standard deviation Bollinger Band, right? Nice uptrend, right, through September and October, right? A little pullback. Nice move, typical Bollinger Band type reaction. And then you see right around mid-October, price is starting to flatten out, but the bands squeeze. Right? It's an example of tightening, right? Where you have chop that it's established. But what it's also doing is when the initial hint of bands starting to squeeze, and you can measure the distance between the two. That's how I do it. So I'm not like looking at it visually. I'm looking at the distance between the red and the blue. When that starts to go inwards, I immediately start either taking my profits, everything else equal, taking profits on trends, or maybe start to establish some chop type strategies. They could be scalping, playing the midline in a Bollinger Band, even options premium selling if you're on a daily or weekly chart. Okay. Things that are you're going to be paid just to ride out time. All right. And we could even go on, if we think about it further, once those bands start to expand again, and this is a great example, look at the peak of that squeeze, right, where those arrows are, right? As soon as they started to expand again, price went back into trend mode in this particular example, the other way, right? So I love Bollinger Bands. This is like the home of Bollinger Bands, desire to trade. I love to use them as a trading vehicle, but I also love to use them as a tool to help me early identify a change in tone in the market. That squeeze is very, very powerful. And it's actually a pretty popular indicator on some platform softwares by a fellow trader, John Carter. So it's great. If you have it on your platform, you could even use it. If it's an indicator there, or if not, just visually look at this and say, where am I? All right. If I'm in a chop trade or I'm in a chop market, and I see these bands start to expand, do you think I'm going to start making decisions? Yes. Okay. And the cool thing is they detect it early, or at least attempt to detect. Let's go to the next slide, Alex. Okay. So we'll summarize with this. Okay. One of the things we get a lot of questions on, I mentioned earlier, is about market context. How come Secretariat is so good this month? We're getting a lot of good, the past 2-3 months. But late last year, it was like Secretariat sucks, right? Well, why is that? Because markets weren't trending, and Secretariat is a trend-based strategy. So it's pretty obvious. The one thing we want to summarize is there's no golden pill. If there was, we'd be gazillionaires, okay? But we do have tools to help us, and the key word here is anticipate a transitioning market. It doesn't always work, but it helps us anticipate, right? Bollinger Band squeeze, Hull moving average, these are things that should make your eyes light up, right? The anticipation alerts, and I put that word there for a reason. The anticipation alerts, along with the math, is the sweet spot. So the separation of the moving averages, the Bollinger Band, tightening, those are all measurable. Those are all data driven. Okay. And Hull moving averages are visual. So you can use math to make these determinations of, are you going to switch or not? Right? Or how do we do that? How do we do it? What are some of the things we can do? We can switch strategies, but also consider size during the anticipated transition, right? So if we're in that chop and we start to see the Hull turn, hinting that maybe there's a trend coming up, lower size. Or if I'm going to get into a new chop trade, I'm going to make it smaller, right? Or if I'm going to anticipate a new trend, maybe I'll start up smaller, right? I'll start with initial size and then add upon maybe confirmation of, okay, now we're in a trend. Now I'm going to add size. This is what hedge funds do, right? They just don't go full size and hope for the best, right? They position size their way into long-term positions. And lastly, it's a question that may raise some eyebrows. How does this affect if you're an algo trader, right? Is there a plan change for your algo? Well, if I'm a day trader and we have 2 or 3 switches every day, I don't think I'm going to be changing my algo. I think that would be foolish, right? But it really is the ultimate backtest. So if we do 5 years of backtesting and say on a weekly chart, when some of these things hint that we're transitioning to a chop phase, what's my outcome, right? Does my backtest more optimized? Now, the golden rule is, and I have done studies on this, had outside studies, and also my personal 20 years of study, is the more you touch, the worse it is. Okay. So if you try to get too fancy, you're better off. And I've had many a times when I've done my journal reports for you saying, if I just left it alone, it would have been fine.
Right, so hope you liked the training today. Hope this was of value, of course, as always. Hope you get some tips you can use and some things you can become better at. Make sure you leave a comment below. Tell me what you got away from this training and what you will apply to your own trading. It's really crucial to apply what we learned here. I don't want you to watch YouTube videos here without any purpose. I want you to apply these things and get results from them. That will make me the most happy. Alright, so if you want to get that program and if you want to learn more about Michael Toma and get help from him and attend these calls every month, I'll leave a link below. The first link will be to sign up for that program. It's called Ultimate Profit from Trading. It's a program we've been running for the past 3 years now, where we teach people how to get funded with prop firms and keep the capital, teaching them to scale up to either a 6 or 7 figure account in the next few months, no matter what stage they're at in their trading. So the link will be below for that. Any questions you can always let me know. I'll be happy to help out. And I'll catch you back here in the next video pretty soon. Ciao.